The biggest Musk-world story today didn't come from Tesla at all. SpaceX bought an artificial intelligence company for $60 billion, briefly became more valuable than Microsoft. And right now, the conversation among Tesla investors is mostly about SpaceX, not Tesla. So tonight, we're going to work through what that actually means for the Tesla shareholder. We've also got Goldman Sachs raising its delivery forecast well above the rest of Wall Street, a fight over Tesla's robotaxi safety record, Tesla emailing its own owners to lobby a state legislature, and a look ahead to tomorrow's Fed decision. This is the Tesla Brief, after the close on June 16th. Welcome to the show. A quick look at the stock. Tesla closed down 1.1% at $404 and change. The Nasdaq was down 1.2%, and the S&P 500 was off 0.6%. So Tesla fell roughly in step with the Nasdaq on a broad down day for tech and growth stocks. Not on anything Tesla did itself. Let's start with that SpaceX story, because it's the one shaping the mood. Here's what happened. SpaceX exercised an option to buy a company called Cursor in an all-stock deal worth $60 billion. All-stock means SpaceX paid with its own shares rather than cash. Cursor makes an AI tool that writes and edits software code, and it's grown fast, over $3 billion in annual recurring revenue, and used inside more than half of the 500 largest US companies. SpaceX had set this up back in April, taking an option to either buy Cursor outright for $60 billion or pay $10 billion to work together. Today, it chose to buy. And the timing matters. SpaceX went public just last Friday, and the stock is up nearly 30% since. Enough that, on today's news, it briefly passed Microsoft to become one of the most valuable companies in the world. So you've got a freshly public Musk company on a tear, making a giant AI acquisition, while Tesla drifts down with the market. You can see why the attention is moved. There are two things here that genuinely matter for Tesla shareholders, and one that's mostly noise. Let's separate them. The first is the capital story, and it's real. Money and attention are rotating towards SpaceX and away from Tesla. The clearest piece of evidence circulating today, Tesla's retail ownership, the share of the company held by everyday individual investors rather than big institutions, has slipped to 31%, according to bar chart data. That's the lowest since the middle of 2025. Longtime Tesla bull Gary Black, who runs the Future Fund, summed up the mood this morning. He wrote, in his words, "I remain on the sidelines on Tesla due to declining earnings estimates, intense autonomous competition, and its extended valuation." That last phrase, extended valuation, just means a stock he thinks is expensive for the earnings it's actually producing right now. When a long-standing bull says he's waiting, that tells you something about where sentiment sits. The second thing that matters is more subtle, and it's actually a point in Tesla's favor. The same kind of AI talent and computing power behind Cursor's coding models is the same stack Tesla leans on for self-driving and for Optimus. Elon's framing today was that AI is heading towards superhuman coding ability and general computer use. Whether or not you take the bold version of that at face value, the underlying point is that Musk's companies are pooling AI expertise, and Tesla sits inside that ecosystem, not outside it. The risk flagged in Bloomberg's reporting today is that this isn't a one-off. SpaceX is pursuing more AI deals and may sell bonds to fund them, so this capital magnet may keep pulling for a while. And that sets up the real near-term question for Tesla holders. Does retail attention rotate back if Tesla posts a strong second quarter? The numbers land in early July? Or does the SpaceX story keep capital pinned in place through year-end? Hold that question, because the next item speaks directly to it. Because while the spotlight has moved, the actual business setup for the second quarter looks like it's strengthening. Goldman Sachs analyst Mark Delaney raised the firm's second quarter delivery forecast for Tesla to 420,000 vehicles, up from 405,000. That's well above the roughly 400,000 the rest of Wall Street is modeling. In his words, "We believe that Tesla's 2Q26 vehicle deliveries are likely tracking ahead of consensus." The driver is Europe. Goldman is modeling something like 85 to 90% growth there versus a year ago, a huge swing, with China up modestly and new contributions from South Korea and Australia. The weak spot is the US, where deliveries have been down in the mid-teens through May. Goldman also nudged up its full-year forecast and its earnings estimate for the year. Two things to keep in view. First, this is now the second analyst in 2 weeks pointing to a stronger second quarter than the bears expect. So it's a pattern, not a one-off. Second, and this is the fair counterweight, Goldman is keeping its price target at $375 with a neutral rating. and Tesla is trading above 400. In plain terms, Goldman thinks the better deliveries are already baked into the price. So a strong number in July might confirm the story without necessarily moving the stock much, unless it genuinely surprises. The delivery release in the first week of July is the firmest near-term event on the calendar. On to the robotaxi side, where there's a useful piece of myth-busting to walk through. Yesterday, a lot of the conversation was about Tesla's robotaxi safety record, a 4-month stretch with 0 at-fault crashes in the federal data. The only fresh incident being a Tesla getting rear-ended while stopped, clearly the other driver's fault. On its face, that sounds like a strong endorsement of the technology, and a version of it pulled well over 1 million views online overnight. Today, Electrek pushed back, and the pushback is fair. The reason the robotaxis aren't crashing, they argue, is that there are barely any of them on the road. The active robotaxi fleet has been shrinking, not growing. It peaked at around 25 vehicles in late April, and is now closer to 20. Tesla has widened the areas the cars can operate in, but the number of cars themselves is flat. So a clean crash record across 20 cars doing limited miles tells you very little about whether the system is safe at scale. This is the honest way to read it. The crash number isn't bad news, but it's not the proof point some are treating it as. And it quietly shifts the question. The thing that actually matters isn't is Tesla's autonomy holding up safely? It's when does the fleet actually start to grow? Tesla has tied serious scaling to a major rewrite of its self-driving software, with the real ramp pushed to late 2026 or early 2027. The crash record doesn't tell you anything about that timeline, and the timeline is what counts. Staying on robotaxi, here's a genuinely new kind of move. Tesla emailed its New Jersey owners today, asking them to contact state legislators about 2 bills the company says would make true driverless operation effectively illegal in the state. Tesla's framing? New Jersey is heading in the opposite direction from states like Texas, where its robotaxis are already running. What's notable here isn't the bill, it's the tactic. This is the first time we've seen Tesla turn its own customer base into a political lobbying channel on self-driving rules at this kind of scale. And it tells you something important about how robotaxi actually expands. The hard part of reaching a new city increasingly isn't the technology. It's the patchwork of state-by-state laws governing driverless cars. That regulatory map is the real gate on the rollout, which is part of why Tesla's expansion beyond Texas has already slipped. The thing to watch is whether other states copy New Jersey's restrictive approach, because if they do, the meaningful robotaxi ramp gets pushed out further than the current late 2026 expectation. There's also a sharp critique worth understanding, from Teslarati, tied to a new version of full self-driving, rolling out this week. Tesla has largely cracked the genuinely hard parts of driving. Smooth acceleration, lane changes, reading the world around the car. But it's still tripping over turn-by-turn navigation, the kind of thing Garmin and TomTom solved 20 years ago. Owners report wrong turns, missed exits, routing onto slow local roads, and cars sent to the back entrances of buildings. The diagnosis is interesting. Tesla stitches its navigation together from 5 different mapping sources, and they don't always agree on lane layouts and turns, so the car hesitates. And here's why this matters more than it sounds. A hesitant car makes for a worse ride, and worse, it can trigger unnecessary handoffs back to the driver. For a robotaxi with no driver in the seat, reliably getting to the destination isn't a nice to have, it's the whole job. If the car can't consistently reach where it's going, the economics of a driverless fleet never come together, no matter how good the rest of the system is. To tell that Tesla knows this, it started surveying owners specifically about these navigation errors. A few quicker items, mostly on the competitive and regulatory fronts. On competition, the autonomy field is widening again, after a year of narrowing toward just Tesla and Waymo. China's Baidu won a full driverless permit in Switzerland, covering an 80 square kilometer area across 3 regions, run jointly with the Swiss Postal Service. That makes it the first to win commercial driverless approval in Europe, ahead of both Waymo and Tesla, which is still at the supervised stage there, a long way from fully driverless. And separately, Mobileye, the Israeli self-driving supplier majority owned by Intel, said today it'll launch its own US robotaxi service by 2027, moving from selling the tech to running fleets itself. None of this changes Tesla's hand overnight, but what it tells us is that every credible new entrant adds pressure on Tesla to actually scale beyond the few dozen cars it's running today. On regulation, last week's Reuters investigation into Tesla's safety claims is now driving action on 2 continents, in opposite directions. In the Netherlands, the transport minister defended the country's approval, telling Parliament its own testing, over 1 million miles on Dutch roads, turned up no noteworthy incidents, and rejecting the idea regulators were misled. In Washington, 2 U.S. senators who've long been Tesla critics, Ed Markey and Richard Blumenthal, asked the federal safety regulator to independently review one of Tesla's claims. Specifically that full self-driving is 7 to 10 times safer than a human, with a response requested by July 7th. What this means for investors? Europe's rollout has political cover for now, but U.S. scrutiny is building into the back half of the year. Tesla formally filed to bring supervised, full self-driving to Taiwan, entering the regulatory review process there, its 13th market. It also said it'll stop selling the one-time, buy-it-outright version of FSD in Taiwan after June 30th, moving to subscription only, as it's already done in Europe and the UK. It's a small data point, but it widens the footprint, while the big prize, China, still has no firm date. That brings us to the one thing on tomorrow's calendar that could move Tesla, regardless of any company news: the Federal Reserve's interest rate decision, at 2 p.m. Eastern. Almost nobody expects a change to rates themselves. What matters is the tone. This is the first meeting led by the new Fed chair, Kevin Warsh, and per CNBC, he's expected to do something unusual: withhold his own projection for where rates go from here. That removes one of the signals investors normally pick apart. Here's why a Tesla investor should care. Tesla swings more than the broad market, and it tends to move hard on the Fed's tone about whether interest rates stay high. If the Fed sounds tighter than expected, more worried about inflation, growth stocks like Tesla tend to take it hardest. If it sounds patient, the opposite. One thing working in the patient direction? Oil dropped below $80 today on a US-Iran deal over the Strait of Hormuz, which takes some pressure off inflation and gives the Fed room to wait rather than lean toward raising rates. So the question to hold overnight is simple. Does tomorrow's statement read tight enough to weigh on Tesla and the rest of the growth crowd? Or does that easing oil price give Warsh room to stay calm? We'll know by mid-afternoon tomorrow. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us.